If you looked at your portfolio right at last week's close on Friday afternoon, I mean, you probably thought the tech sector was just catching on fire.
Oh, absolutely. The red ink was just spilling everywhere.
Right, spilling everywhere. And I think the instinct for a lot of people, it was to just run for the exits.
Yeah, totally rational response on the surface.
Right. But if you take a step back and actually look at what institutional money was doing behind the scenes, they weren't panicking. They were quietly setting a trap.
Which is really the fundamental difference between just trading the tape and actually understanding the mechanics beneath it.
Exactly.
Because if you're just reading the surface level price action, you are missing a massive structural shift in how capital is being positioned right now.
And getting you ahead of that shift is really our entire mission for this deep dive today. So it's Sunday morning, June 28th, 2026.
Yep, market is closed, giving us a second to breathe.
Much needed, honestly. Because tomorrow morning, the opening bell is going to ring on one of the most structurally complex, low liquidity weeks we've seen all year.
Oh, without a doubt. It's a minefield.
So to prep you for it, we're unpacking a really dense top-tier institutional strategy report. It's the Bulls, Bears, and the Bell. June 2026 strategy report.
And just to clarify, this isn't, generic financial news.
Right, no. This is the raw, data-driven playbook that institutional traders are literally reviewing right now over their morning coffee.
Resetting the deck for Monday.
Exactly. So, okay, let's unpack this. After the brutal tech sell-off we just witnessed last week, are we looking at the start of a prolonged market crash, or, is there a massive hidden opportunity setting up in all this chaos?
Well, I think it's entirely rational to feel a sense of vertigo looking at that weekly candle. I mean, the technical damage was significant.
That was ugly.
Super ugly. But when we zoom out and isolate the underlying institutional volume, the narrative completely flips.
Wait, really? Flips how?
The data strongly suggests the smart money is not preparing for a doomsday scenario. They are actually positioning for a counter-trend move that's going to catch a lot of retail investors completely off guard.
Okay, we definitely need to dig into that. But let's start with the rearview mirror first to kind of understand the current market psychology.
Right, the damage.
Yeah, because the technical damage is what's driving all the headlines right now. The S&P 500 closed Friday with what this strategy report calls a heavy bearish rejection.
Yeah, down for 5 straight days.
Which is the longest daily losing streak the broader market has suffered since, what, August 2025?
Yep, August 2025.
So shed 1.95%, closing at 7,354.02.
So that low volatility summer rally we've been riding, that is officially paused.
Yet in its tracks.
Right. The S&P lost its 50-day moving average, and it completely failed to hold that critical pivot level around 7,360.
Which signals classic buyer exhaustion. But the real story, I mean, it's the concentration of that damage.
Oh, definitely. The Nasdaq 100 took a massive hit.
Plunging, like 4.5 to 5%, right?
Yeah, closing near 29,118.24 and dragging the broader composite down to 25,297.62.
And the high-flying semiconductor darlings, NVIDIA, Broadcom, Micron, they faced just incredibly heavy distribution.
Institutions were aggressively selling those specific names.
So the report labels the core macro theme here as AI valuation fatigue meets sticky inflation.
Which is a profound shift in sentiment. Up until now, the market was perfectly willing to pay any multiple for AI exposure.
Any premium at all.
Right. But that enthusiasm just hit a mathematical wall.
It makes me think of, it's like buying a hypercar. Like you go out and buy the absolute most expensive state-of-the-art sports car.
Okay, I like where this is going.
You're thrilled, right. But then you start driving it and you realize the cost of the premium specialized racing gas you need just to keep the engine from stalling is completely draining your bank account.
Right, the buyer's remorse kicks in at the pump.
Exactly. The thrill of the purchase turns into this harsh reality check. In this market, that premium gas is the AI capital expenditure, the data centers, the power grid upgrades, the relentless need for new silicon.
That analogy hits it perfectly. The sticker shock is hitting the market right now, and to understand why, you just have to look at the hardware supply chain. Yes. Apple just made this huge strategic decision to hike the retail prices of their iPads and MacBooks.
And they aren't doing that just to, pad their margins.
No, they're doing it because the underlying memory and component costs are absolutely soaring.
Which is just a glaring wake-up call for investors. You have these tech titans finally passing their ballooning AI hardware costs directly down to the everyday consumer.
Right, and this collision is happening exactly as the May inflation data just ticked above 4% for the first time in 3 years.
So supply chain inflation is really biting back here.
Exactly. The market is looking at sticky inflation above 4%, realizing the Fed is backed into a tight corner on rates, and suddenly questioning the actual ROI on all these multi-billion-dollar AI expenditures.
So on the surface, if inflation is rebounding and tech stocks are plunging, it sounds like total panic. Like we should brace for a catastrophic Monday.
It does sound like that.
But here's where it gets really interesting. When you look past the price action and transition into the actual liquidity data, the institutions aren't behaving like there's a fire at all.
Far from it, actually. They definitely aren't retreating into cash.
So let's break down Friday, June 26th, the Russell reconstitution.
Oh, this was wild.
Yeah, for anyone who doesn't track the plumbing of the stock market, this is an annual event where the Russell indexes basically rebalance their weightings.
Right, so index funds are legally obligated to buy and sell billions in a matter of seconds.
Right. And the Nasdaq closing cross processed an absolutely staggering 4.59 billion shares.
It's hard to even wrap your head around that number.
We're talking about $334.027 billion moving in just 1.63 seconds.
The largest single liquidity event of the year so far. And what is vital to understand here is where that capital actually went.
Because according to the volume profile in the report, that money didn't just evaporate.
No, it rotated. Institutions actively rotated out of those high multiple AI stocks and parked it into defensive equal weight sectors.
Specifically, they were buying up healthcare and consumer cyclicals.
Right.
But, okay, here is the macro twist that really threw me. While tech was getting hammered, the U.S. 10-year Treasury yield broke down below its massive 4.45 to 4.5% support floor.
Yep, closing way down at 4.38%.
And the catalyst there was geopolitical.
Yeah.
U.S.-Iran diplomatic progress effectively de-risked the Strait of Hormuz.
Which caused oil prices to plummet.
Right, wiping out that whole war-driven inflation premium on energy.
Yeah.
But wait, I have to challenge this logic for a second.
Sure, go for it.
Because the traditional playbook says this is completely backwards. If oil is down and the 10-year yield is dropping, shouldn't tech stocks be rallying?
You would think so, yeah.
Because cheaper borrowing costs usually act as a green light for growth tech. Why did the Nasdaq take a 5% haircut while yields were literally moving in its favor?
What's fascinating here is the distinction between a macroeconomic tailwind and a microeconomic reset.
Okay, unpack that.
You're entirely right that in a standard cycle, falling yields expand tech multiples. But this specific sell-off, it had nothing to do with the broader cost of borrowing capital.
Oh, so it's just localized.
Exactly. It was a highly targeted, localized reset purely on AI valuations and hardware costs.
So they were punishing the AI capex, not the macro environment.
Precisely. The rotation is structural, not systemic panic. Because if this were a true panic, we'd see the Nasdaq absolutely shatter its technical floors.
But it didn't.
It didn't. The Nasdaq 100 actually managed to defend its critical 28,960 support line by an absolute thread after dipping intraday.
The trend line bent, but it refused to break.
Which tells us the underlying market structure is bruised, yeah, but it's totally intact.
And that sets the stage for what looks like an incredibly compressed and, frankly, kind of dangerous setup for the week ahead.
Oh, it's a pressure cooker.
Because we have to squeeze the macro calendar. We are heading into a shortened holiday week. U.S. markets are totally closed on Friday, July 3rd for Independence Day.
Which means a whole week's worth of volatility and data is violently crammed into 4 days. By Thursday afternoon, liquidity is just going to evaporate.
It's like trying to safely pack a crate full of fireworks into the trunk of your car right before a bumpy road trip.
Right, one pothole and you're in trouble.
Exactly.
Yeah.
Because of that low holiday liquidity, there are fewer buyers and sellers to absorb the shocks. One surprise data print, and the whole thing explodes.
So we really need to watch the red folder events acting as those potential potholes.
Let's start with Tuesday morning. We get the JOLTs job openings for May.
Right, and consensus is looking for a drop down to 7.28 million from April's blowout 7.618 million.
But if that print comes in hot?
If it's hot, it signals to the Fed that corporate labor demand is still stubbornly high. Wage pressures aren't dead, and high wages mean inflation stays high.
Which leads right into Wednesday. Fed Chair Kevin Warsh is speaking in Sintra.
Right, and remember, the Fed funds rate is currently sitting at that 3.5 to 3.75% range, with the median 2026 projection at 3.8%.
And we also get the U.S. ISM manufacturing PMI that same morning. Consensus expects a continuation of May's 54.0 high.
So if Chairman Warsh uses that podium to point to a strong labor market as justification for keeping rates tight, growth stocks will sell off hard.
The market will instantly price that in.
Instantly.
But the absolute grand finale of this whole fireworks display is Thursday. Because of the Friday holiday, the non-farm payrolls report, the NFP, it drops a day early.
Which is huge. Wall Street consensus is targeting, 114,000 to 145,000 jobs.
Yeah, and unemployment holding steady at 4.3%.
Yeah.
So break down the binary risk for us on this specific print, because this seems like the linchpin for the whole month.
It really is. It's totally binary. If Thursday's NFP print is a blowout, like over 160K jobs, the Fed is effectively forced into a strict higher-for-longer rate path.
So a 2026 rate hike becomes practically a certainty.
Exactly. And in a low-liquidity holiday environment, that crushes equities.
But if it goes the other way, like if the hiring pace cools down,
say it prints under 100K, then it confirms the labor market is cooling exactly how the Fed wants. Bonds rally aggressively, and stocks can finally breathe.
okay, so we have this intense binary risk on the table. The market just took a beating, and everyone is staring at a shortened week.
Yep.
How is the smart money actually placing their bets right now compared to just, the average retail investor?
Well, let's look at the sentiment divergence, because this is where the strategy report gets really revealing.
Yeah, the CNN Fear and Greed Index plummeted from 71 down to 25, which is deep fear.
And the S&P 500's 14-day RSI reset down into the low 40s.
Meaning the market is officially no longer overbought.
Right. That speculative froth from early June has been completely washed out.
Yet, when you look at the AIII sentiment survey, retail investors are still highly bullish.
Right, sitting at 44.9% bullish.
They are eagerly trying to buy the dip. But if we pivot away from retail and look at the CFTC's Commitment of Traders data, the COT report, institutional positioning is doing something else entirely.
Yeah, the COT data shows a massive sudden collapse in short covering by the smart money.
The speculative net shorts on the S&P 500 literally collapsed from negative 194K to just negative 35.4K.
It's a huge drop. And Nasdaq 100 net shorts are incredibly lean right now, sitting at just negative 9.1K.
And on top of that, Micron just dropped their Q3 fiscal 2026 earnings and delivered stellar forward guidance.
Proving the fundamental AI demand is still very much alive.
So, okay, what does this all mean? I mean, if everyone is so fearful, why are the massive hedge funds abruptly closing their short bets?
Because of a concept known as the pain trade.
The pain trade. Okay, break that down for us.
Sure. So markets have a funny, often cruel tendency to move in the exact direction that causes the maximum amount of financial pain to the majority of participants.
Okay, so how does that work mechanically here?
Imagine you're a hedge fund manager. You shorted the tech sector a few weeks ago when it was overbought, and you made great money as the market fell for 5 days. But now you look at the technicals. You see the Nasdaq defending its support floor, you see the RSI cooling off, and Micron proving the AI narrative isn't dead. What do?
I mean, you take your profits before they vanish, you close the short.
Exactly. And how do you close a short position? You have to literally buy the stock back.
So when large institutions start closing their shorts simultaneously,
it creates this massive wave of forced buying pressure. Because the overbought froth is gone and those funds cleared their short positions, there is very little active resistance overhead.
the ceiling is basically clear.
Totally clear. So if tech, specifically semiconductors, manages to find its footing early this week, all that sideline cash is going to be forced to chase the market higher.
So they don't miss the rebound.
Exactly. The pain trade right now is actually a violent squeeze-you-pee.
Wow. A short covering rally that grabs everyone sitting in cash and just forces them back in.
Yep. If you're expecting the floor to fall out and it rips higher instead, the pain of missing out, plus that mechanical buying from short sellers, it forces prices even higher.
And in a holiday-shortened week with low liquidity, those upward moves can be just explosive.
Absolutely explosive.
So let's bring all this dense data down to a practical reality for you listening. If you are watching the market tomorrow, here's the game plan based on the strategy report.
You really need to bifurcate the market based on the macro data we get on Wednesday and Thursday.
Right. If that labor data and Chairman Warsh come in hot, validating the inflation fears, look at how defensive sectors perform.
Energy, which is ticker XLE, and industrials, ticker XLI.
Because they act as institutional hiding spots when rates rise.
Conversely, real estate, ticker XLRE, and tech, ticker XLK, they are highly sensitive to borrowing costs.
So they are the most vulnerable to a rate hike.
Hmm.
But if the labor data cools down on Thursday,
Then those exact same vulnerable sectors, XLRE and XLK, become the prime candidates for that massive short covering rally we just talked about.
so it is really a market entirely driven by the tension between AI capex and inflation. And whether you are actively trading or just want to be the smartest person at your next meeting, understanding why the market moves is your real superpower.
And, if we connect this back to the broader picture, there is a really provocative question here.
Yeah.
Think about it. If a simple AI hardware price hike from Apple was enough to trigger a massive multi-billion-dollar market reset and inflation panic,
It really shook the foundation.
it did. So how fragile is this whole AI productivity miracle narrative down the line?
Oh, wow.
Right? What happens if everyday consumers eventually just look at the price tag for an AI-enabled laptop and refuse to pay the premium?
The cycle breaks. Who pays for the data centers then?
Exactly.
Man, that is a multi-trillion-dollar question hovering over this entire market cycle. Thank you for joining us on this deep dive. Stay curious, watch how the data unfolds before the holiday weekend, and we'll see you next time.